This lesson briefly introduces the area of financial management, where it fits in an organization and what type of questions it attempts to answer. Finance in general has two major legs, corporate finance and investments. This is corporate finance, or Corp Fin, addressing the finance issues faced in a corporation. As the slide indicates, we're going to look at forms of business organization, creating value for investors, Stockholder-Manager Conflicts, and Stockholder-Debtholder Conflicts, as well as balancing the shareholder interest and society interests. Looking at this basic org chart, you can see there are two legs, the operating leg on the left and the administrative leg. We're concerned with the administrative or finance leg, typically headed by the Chief Financial Officer or a VP of Finance. Under the CFO, our functions are typically delineated between Treasury and Controller. Treasury functions are finance. The Treasury function includes cash and credit management, which we don't address in this course. Treasury also focuses on capital expenditures and financial planning. That's our focus. Controller functions are accounting, so it's easy to see how accounting and finance work together in a corporate environment. The main focus in this course is capital budgeting, how the company chooses which long-term investments to pursue. Capital structure, or how the firm is funded, and working capital management are addressed in more advanced classes. The three basic forms of business organization are sole proprietorship, partnership, and corporation. Since this is a course focused on corporate finance, we're clearly focused on the third form, but we need to understand the differences. Most corporations start as sole proprietorships and grow. Sole proprietorships and partnerships are very similar in that partnerships are a group of sole proprietors who come together and agree on how to split the profits. Sole proprietorships and partnerships do have some advantages. They're very easy to form. You can be a sole proprietor tonight by selling something on eBay. A sole proprietor is subject to very few regulations. All income flows to you as ordinary income. On the other hand, if the business flourishes, it's difficult to raise funds to expand. A sole proprietor has unlimited personal liability. And when the sole proprietor or a partner dies, the business dies with him. These are sometimes set up as LLCs, limited liability corporations, or LLPs, limited liability partnerships. You'll see these with law firms and medical practices where each individual carries their own liability insurance. Corporations also have significant advantages. A corporation is an entity separate from its founders, owners, and managers. Technically, its life is unlimited. Ownership in a publicly traded corporation is easily transferred by simply buying or selling shares of stock. Owners of a corporation have limited liability. If you buy a share of stock for $20, $20 is all you can lose. You cannot be held liable for the actions of the corporation. Corporations can raise capital in a lot of ways, lines of credit, issuing bonds, issuing stock. But corporations' profits face double taxation, once as a corporation and again as dividends are paid to the owners. And the cost of setting up a corporation is significant, as well as the continuing regulatory requirements for filings with the SEC, notices to shareholders, not to mention compliance with Sarbanes-Oxley. When a stock is in equilibrium, its market price equals its true or intrinsic value. Differences in investor perceptions can cause stock prices to deviate for short periods. Intrinsic value is a long-run concept. Our objective in this course is to learn the methods to use to identify investments that will increase the value of the firm and thus the stock price in the long run. Managerial actions clearly determine the direction of the firm. As insiders, management knows intimately what the firm is doing and what the true value of the stock should be. As outsiders, we have to depend on signals. We watch what management says in news announcements and does in terms of reported insider trading. From those signals, we try to determine the true value of the stock. If our perceptions are in sync with what insiders know, then the stock is in equilibrium. U.S. stock markets are highly informationally efficient, so we assume most stocks are in equilibrium most of the time. In a corporation, the shareholders are the owners who hire managers to run the company. Remember, the goal of corporate management should be to maximize shareholder wealth, which means maximize the stock price. But managers tend to act in their own best interest, not the shareholders. golf club memberships, private jets, for example. These are called agency problems, since managers act as agents for owners. To try to align management's interest with stockholders, a firm may use several techniques: managerial compensation, stock options, direct intervention by the shareholders, proxy votes, threat of firing, threat of takeover. Poorly managed companies are ripe targets for takeover. Conflicts can also exist between stockholders and bondholders. Stockholders' liability is limited to the price they paid for a share of stock, but if the firm turns out to be the next Google, they win big. Thus, shareholders want the firm to take on risky projects. Their downside is limited, but their upside is not. Bondholders have loaned the company money. All they want is their periodic interest payments and their loan back at the maturity of the bond. They do not want risky investments. They want stability. But bondholders don't vote, so they may try to protect themselves with what are termed protective covenants in their bond agreement that limits what the firm can do that might damage the value of their bonds. The main takeaway from this chapter is on this slide. The primary goal of management is to maximize shareholder wealth, which means maximize the stock price. All decisions should be made with that goal in mind. Social responsibility is not inconsistent with maximizing shareholder wealth, but must be carefully considered. This ends our introduction to financial management.